Imagine being offered a stock for $1,000 and saying no because you knew it was only worth $500. Everyone else calls you crazy until the market crashes and your wisdom becomes obvious. That's the kind of thinking that made Warren Buffett one of the richest people in the world. And he credits one book more than any other for teaching him how. The Intelligent Investor by Benjamin Graham. Buffett didn't just read it, he devoured it. At 19, it changed his life. And in this video, we're going to break down why, with stories, metaphors, and simple truths that could rewire how you see money. This isn't just a book about stocks. It's a masterclass in how to stay sane in a world that loses its mind every time the market moves. So what makes someone an intelligent investor? It's not IQ. It's not insider tips. It's not timing the market. According to Graham, it's temperament, patience, logic, discipline, and understanding how to buy $1 bills for 50 cents without flinching when everyone else panics. Stick with me, and you'll learn how to think like Buffett, invest like Graham, and build lasting wealth the smart way. Section 1. Who was Benjamin Graham? Before Warren Buffett became the Oracle of Omaha, he was just a young man searching for answers. And he found them in the teachings of one man, Benjamin Graham. Graham wasn't born into wealth. He was born in 1894 in London, moved to New York as a child, and watched his family lose everything during the Panic of 1907. That trauma didn't break him. It sharpened his mind. He went on to graduate second in his class from Columbia University at just 20 years old and dove headfirst into the world of Wall Street. But Graham wasn't dazzled by Wall Street's glamour. He saw through the noise. While others were chasing quick wins, he asked, what if there was a safer, smarter way? Then came the Great Depression. Graham lost a fortune, and most people would have quit. But he didn't. He studied, he reflected, and most importantly, he learned. He realized that markets are driven by human behavior, and human behavior is often irrational. He built an investment philosophy grounded in facts, patience, and logic, not fear or excitement. He crafted principles like margin of safety, the distinction between speculation and investing, and perhaps his most famous mental model, Mr. Market. In 1949, he released his masterpiece, The Intelligent Investor, a guide not just to stocks, but to thinking. Warren Buffett once said, reading this book changed my life. It was like having a roadmap to financial sanity. Graham didn't promise fast money. He offered something far more valuable, a strategy to build wealth slowly, safely, and smartly. And in the next chapter, we'll explore the very first of Graham's big ideas, one that separates the gamblers from the wealth builders. Section 2. Investor versus Speculator. In the eyes of Benjamin Graham, there are two kinds of people in the stock market: investors and speculators. And here's the catch. Most people don't know which one they are. Graham defined an investor as someone who makes decisions based on analysis, safety of principle, and an adequate return. In simple terms, you study what you're buying, you protect your money, and you don't swing for the fences without knowing where the ball is going. A speculator, on the other hand, bets on market movements. They buy because something is hot. They sell because of fear or hype. And they often get burned. Graham warned, the investor's chief problem, even his worst enemy, is likely to be himself. Let me tell you a story. In the late 1990s, during the dot-com boom, everyone wanted in. Tech stocks were skyrocketing. A company didn't even need profits, just a website and a buzzword. People quit their jobs to day trade. College students took out loans to invest. Even taxi drivers were giving stock tips. Buffett, armed with Graham's wisdom, stayed out. People called him old-fashioned, out of touch, boring. But when the bubble popped, trillions vanished. People lost homes, retirements, and confidence. And Buffett, he stayed wealthy, calm, and patient. Because those who followed Graham's approach had something the speculators didn't: a philosophy, a compass. Because the investor doesn't chase. The investor waits for value. Imagine you're shopping for a car. You wouldn't pay more just because the dealership is packed with people waving cash, right? Yet that's exactly how speculators behave with stocks, driven by crowd noise, not common sense. Graham's first principle is this: know why you're buying. Base your decision on what a business is worth, not what the market is shouting. Ask yourself, if the market shut down for 5 years, would I still be happy owning this company? If the answer is no, you're not investing. You're gambling. Graham didn't say speculation was evil. He just believed it was dangerous when people didn't realize they were doing it. Investing, by contrast, is boring until it's beautiful, because it builds, slowly, surely, wisely, over time. And now let's meet Graham's most bizarre, brilliant metaphor, Mr. Market. Section 3, Meet Mr. Market. Imagine every morning a man named Mr. Market shows up at your door. He's holding a price tag for every stock you own. Some days he's euphoric. "Buy more!" he shouts. "Prices are going to the moon." Other days he's panicked. "Sell everything, the end is near." This man is moody. He's irrational. And worst of all, he never shuts up. Benjamin Graham invented Mr. Market to represent the emotional roller coaster of the stock market. His goal was simple: to teach investors that the market doesn't tell you what a business is worth. It tells you what people are feeling: fear, greed, euphoria, despair. Here's the trick: you don't have to listen to Mr. Market. You can ignore him. You can laugh at him. And you can absolutely take advantage of him. Let me give you an example. Say you own shares in a company worth $100. Tomorrow, Mr. Market offers to buy your shares for $80. The next day, he offers $120, then back to $90. What changed about the business? Probably nothing. But if you let Mr. Market's mood swings control your decisions, you'll always be reacting, not thinking. Graham taught this: be the master, not the puppet. The stock market is there to serve you, not instruct you. Buffett once said, "I let Mr. Market serve me. He's there to offer me deals, not to guide my emotions." Buffett treats the market like a farmer treats weather. You don't plant your crops based on every cloud that passes. You plant based on seasons, cycles, and discipline. Because Mr. Market isn't your advisor. He's your manic neighbor. And like any unstable neighbor, he shows up loud, impulsive, and often wrong. If he's selling cheap and you've done your homework, you buy. If he's overpaying, you sell. If he's out of his mind, you ignore him. What matters isn't his price, it's your principles. Mastering Mr. Market is like gaining a superpower in investing. You stop reacting and start thinking independently. And now, we move to one of Graham's most powerful shields against risk, a concept that every investor should tattoo on their brain: the margin of safety. Section 4, Margin of Safety. Let's say you're building a bridge that can support 10,000 pounds. Would you drive a 999-pound truck over it every day? Of course not. You'd leave a buffer, a margin, to protect against the unexpected: a gust of wind, a hairline crack, a mistake in your calculations. That's exactly what Benjamin Graham meant by the margin of safety in investing. When you buy a stock, you're making a bet on the future of a business. But what if your analysis is wrong? What if earnings fall? What if the economy shifts? Graham's solution: only buy when a stock is priced significantly below its true value. That gap is your safety net. It protects you from being mostly right, but still losing money. Warren Buffett calls this concept the 3 most important words in investing. He won't invest unless there's a cushion, a built-in layer of protection against misjudgment or surprise. Let me tell you about one of Buffett's favorite deals. In the 2008 financial crisis, while most investors were panicking, Buffett invested $5 billion in Goldman Sachs. Why? Because the price was so low, and the terms so favorable, that even if things got worse, he still had room to be wrong and profit handsomely. And that's the essence of a margin of safety. It doesn't make you immune to loss, but it tilts the odds in your favor. It gives you space to breathe, space to be human, and space to recover from small mistakes. Here's how you apply it in real life. Let's say your research shows a company is worth $100 a share. Do you buy at $99? No, you wait for $70, maybe even $60. You want a discount that absorbs your uncertainty and gives you confidence in storms. Because here's the truth: the future is uncertain. And investing isn't about perfection, it's about protection. Graham's principle is this: never rely on hope. Rely on math, discipline, and margin. It may feel boring. It may feel slow. But this margin is what turns risky gambles into long-term wins. Next, we'll uncover a key distinction: the difference between price and value, and why chasing price is one of the biggest traps investors fall into. Section 5, Price versus Value. Imagine walking into a store and seeing a $300 leather jacket marked down to $100. You're excited, but only if you believe the jacket is really worth $300. That's the difference between price and value. Price is what you pay. Value is what you get. Benjamin Graham said that the market is constantly shouting prices at you: up, down all around. But those numbers don't tell you what the business is truly worth, just what people are willing to pay at the moment. The trap? Most people think the stock market is a scoreboard. Stock up, company doing great, stock down, that must be failing. Wrong. Graham taught that in the short term, the market is a voting machine, driven by popularity, hype, headlines, and herd behavior. But in the long term, it's a weighing machine. It reflects the actual value of the business. Let's break it down. If a stock falls from 50 to 30, is it a bad investment? Not necessarily. If the business is solid, profits are growing, and fundamentals are intact, it could be an incredible buying opportunity. The market just hasn't caught up yet. On the flip side, if a stock rockets from $100 to $200, that doesn't mean the business doubled in value. It may just be inflated by hype and ripe for a fall. Buffett learned this early. He said, "Price is what you pay. Value is what you get." His strategy? Ignore the crowd. Focus on the company. He looks at earnings, assets, leadership, and long-term potential. Then he asks, is this business worth more than what it's selling for? That's the secret. You don't invest in tickers. You invest in companies. And when you think like an owner, not a gambler, you start to see through the noise. You stop chasing prices and start building value. So the next time you see a stock jump 10% in a day, ask yourself, has anything truly changed? Or is this just noise? Because knowing the difference between price and value, that's where real wealth begins. Next, we dive into Graham's 2 types of investors and help you discover which one you really are. Section 6. 2 types of investors. Benjamin Graham believed there are only 2 kinds of investors in the world. Not bulls and bears. Not day traders and hedge fund managers. But this, the defensive investor and the enterprising investor. Let's meet them. The defensive investor is cautious. Not lazy, just careful. They don't want to beat the market. They just want steady, reliable returns without getting burned. Think of someone who buys index funds, sticks to blue-chip companies, and doesn't check the stock app 5 times a day. This person values peace of mind over adrenaline rushes. They believe in diversification, consistency, and ignoring the hype. They're not trying to be a genius. They're just trying to win by not losing. On the other side, there's the enterprising investor. This person digs deep. They read balance sheets on weekends. They look for undervalued gems in obscure places. They want to beat the market. And they're willing to put in the work. They're not gamblers, they're researchers. They don't jump into a stock because it's trending. They jump in because they've studied the numbers, the management, the competitors, and the risks. Here's the catch. Neither path is better, only better for you. If you don't have the time, temperament, or interest to research stocks deeply, don't fake it. Be a defensive investor. Focus on low-cost index funds, dollar-cost averaging, and long-term growth. Let time do the heavy lifting. But if you love the process, if you truly enjoy diving into company reports and financial statements, and you can stay calm when the market panics, then you may thrive as an enterprising investor. Graham warned, the investor's chief problem, and even his worst enemy, is likely to be himself. If you choose the wrong strategy for your personality, you'll either burn out or panic at the wrong time. Know yourself. Pick your lane and stick with it, because the market doesn't reward speed. It rewards clarity, patience, and consistency. Up next, we explore how Graham thought about risk and why volatility isn't your enemy, but often your greatest opportunity. Section 7. Understanding risk. When most people hear the word risk, they think of danger, losing money, stocks crashing, chaos. But Benjamin Graham saw risk differently. To him, risk isn't volatility. It's the chance of permanent loss. Let me explain. Imagine buying a stock for $100. A week later, it drops to $90, then $80. You panic. You sell. Did you lose because the stock was volatile? No. You lost because you reacted emotionally. Volatility is normal. It's part of the game. Stocks go up and down, sometimes for reasons that have nothing to do with the actual business. Graham taught that the real risk is buying without knowing what you own, or overpaying for hype, or panicking when the market sneezes. He said, the intelligent investor is a realist who sells to optimists and buys from pessimists. Here's what that means. When everyone's greedy, prices rise. When everyone's scared, prices fall. If you follow the herd, you'll buy high and sell low, the opposite of what builds wealth. Let's take a real example. In 2000, tech stocks were flying. Everyone thought they were geniuses. Then the dot-com bubble burst. Companies with no profits, no products, and no plan crashed 80 to 90%. Why? Because people confuse hype with value. They ignored Graham's golden rule, margin of safety. Now flip it. In 2008, everything crashed. Solid businesses, profitable, well-run, and undervalued, were trading at bargain prices. Smart investors didn't see risk. They saw opportunity. Graham believed risk came from not knowing what you're doing, from chasing trends, from overconfidence, and most importantly, from not having a plan. The intelligent investor asks, is this business solid? Am I paying a fair price or getting a margin of safety? Can I sleep at night owning this, even if it drops 20% tomorrow? If you can say yes, then the market's mood swings shouldn't scare you. Because real risk isn't about prices moving. It's about you moving at the wrong time for the wrong reasons. Next, we'll meet Graham's most famous metaphor, a character called Mr. Market, and how he can either make you rich or drive you crazy. Section 8. Mr. Market. Imagine you have a business partner named Mr. Market. Every single day he knocks on your door and offers to buy your shares or sell you his. The catch? His mood changes constantly. Some days he's wildly optimistic. He offers a crazy high price to buy your shares. Other days he's full of doom and gloom. He's desperate to sell at a dirt cheap price. Here's the key. You don't have to act on his offer. You can ignore him or take advantage of his mood swings, but you're never forced to play. That's Mr. Market, the emotional, irrational, and erratic force that represents the stock market. Benjamin Graham created Mr. Market to teach us one crucial lesson. The market is there to serve you, not to instruct you. In other words, just because a stock's price goes up or down doesn't mean the business has changed. It's just Mr. Market having a mood swing. Let's make this real. Say you own a solid company. It's growing, profitable, and well-managed. But suddenly there's bad news in the headlines. The stock drops 15%. Mr. Market shows up in a panic, offering to sell at a bargain. Do you panic too? Or do you smile and buy more? This is how Warren Buffett made billions. He waits for Mr. Market to act irrationally, and then he acts rationally. He once said, "You don't have to swing at every pitch. Wait for the fat pitch." In investing, that fat pitch is when Mr. Market offers you a great business at a silly price. But here's the catch. Most people don't see Mr. Market. They become him. They ride the emotional roller coaster. They buy high when he's excited and sell low when he's scared. The intelligent investor, he watches Mr. Market like a poker player. Calm, patient, strategic. Because Mr. Market's mood isn't a signal, it's an opportunity. When you understand this, you stop reacting to the noise and start profiting from it. Next, we'll explore how Graham's ideas gave rise to a principle Warren Buffett swears by, investing with a long-term mindset. Section 9. Long-term thinking. There's a secret weapon in investing that almost no one talks about. It's not stock picking. It's not timing the market. It's not insider information. It's long-term thinking. Benjamin Graham believed that the stock market is designed to transfer money from the impatient to the patient. And no one embodied this more than his student, Warren Buffett. Buffett once said, "Our favorite holding period is forever." That's not a slogan. It's a strategy. Why? Because the real magic of investing is compound growth. And compounding only works if you give it time. Think of a snowball rolling down a hill. At first, it's tiny. But as it rolls, it picks up more snow. And more. And more. Until it becomes a massive force. That's what long-term investing does to your money. But here's the problem. Most people can't wait. They want results now. They check their portfolio daily. They react to headlines. They chase hot stocks. And in doing so, they interrupt the compounding process. Graham warned against this. He said intelligent investors don't try to predict the next big trend. They don't jump in and out of markets. They pick sound businesses, buy them at a reasonable price, and then they wait. Years, sometimes decades. Let's look at Buffett again. He bought Coca-Cola in 1988. People laughed. A soda company? Really? But over time, Coke grew. It paid dividends. It expanded globally. And Buffett held on. Today, that investment has returned more than 15x just by staying put. That's the power of long-term thinking. And it's not just about money. It's about mindset. It's about resisting the urge to do something every time the market shakes. It's about trusting your process. And it's about realizing that wealth isn't built in bursts. It's built in silence over time. So, the next time you're tempted to make a quick move, ask yourself, will this matter in 10 years? Because the intelligent investor doesn't aim to win tomorrow. They aim to win forever. Next, we tie everything together with timeless advice from Graham and give you a practical blueprint for applying it in your own life. Final section, the Intelligent Investor's Blueprint. So you've learned the principles. You've heard the stories. But now comes the big question. How do you actually become an intelligent investor? Benjamin Graham didn't just write theories. He gave us a way of life, a mindset, built to survive panic, hype, and everything in between. Let's break it down into a simple, actionable blueprint you can follow starting today. 1. Know yourself before picking a stock. Pick your strategy. Are you defensive, seeking steady returns without stress? Or enterprising, willing to dig deep and do the research? Be honest. Your personality matters more than your predictions. 2. Think like an owner. Don't buy tickers. Buy businesses. Ask, would I be happy owning this company for 10 years, even if the stock market shut down tomorrow? If the answer is no, walk away. 3. Ignore Mr. Market. Remember, he's emotional, irrational, and always knocking. You're not obligated to listen, only to act when the price makes sense. 4. Insist on a margin of safety. Never bet your wealth on perfection. Things go wrong. Plans change. Only invest when there's a cushion, a gap between price and value. 5. Play the long game. Real wealth isn't built in days. It's built in decades. Let time, patience, and compound growth work for you. Don't interrupt the process with panic. 6. Stay humble. You'll make mistakes. So did Graham. So does Buffett. The goal isn't perfection. The goal is discipline. And finally, 7. Always keep learning. Markets evolve, but principles endure. The intelligent investor never stops growing, because wisdom compounds too. This isn't just investing advice. It's life advice. Be thoughtful, be patient, be rational. And while the world chases shortcuts, you'll be quietly building something far more powerful, lasting wealth. That's the legacy of Benjamin Graham. And if you found this journey valuable, remember to like, subscribe, and share this with someone who needs to hear it. Because becoming an intelligent investor starts with one simple step: choosing to think differently.